And welcome to Armanino's Town Hall discussion on CARES and SBA disaster loans. Before we get started, a brief note on the webinar console we're using today. We've received many questions in advance, and I know many have come in this morning as well. You are welcome to continue submitting your questions via the chat function in the control menu on the webinar console. It should be towards the bottom right. And of course, we will answer as many as we can during the discussion today, but we know that there are lots and lots of questions, so we will get back to as many of you as we can that we aren't able to answer live today. So we will go ahead and dig right on into it. So this morning, our presenters are John Schweisberger, David Miller, and Jen McCabe, who are all partners on our business outsourcing services team here at Armanino. We also have John Kogan, who is a director on our business outsourcing services team, and Matt Petrowski, who is a director on our tax team. All of them are great experts in their fields, and they've done a lot of research on today's topic. So I'm going to go ahead and pass it over to John Schweisberger to go ahead and get us started.
Thank you, Megan. Good morning, everybody. We've got a lot to cover today, and I'm hoping that this will be helpful to you as you get through this process that is a pretty crazy process around the different loans associated with the CARES Act. So what we're going to talk about today are essentially the two main loans that are available to the majority of businesses in the United States. One is the Paycheck Protection Program, or PPP, and the other is the Economic Injury Disaster Loan, which is generally referred to as an EIDL loan. I want to talk about the main differences between those, and then we'll kind of get into the details in particular around the PPP, because that's the one that is got the most interest at the moment. So the maximum loan amount on the PPP is a $10 million total. That's based on your monthly payroll costs, and we'll go through the calculations on that here in a little bit. The terms of the PPP loan have changed just since yesterday. They are now, it's a 1% loan with a 2-year maturity. That was released yesterday afternoon. Unlike most SBA loans, this one is going to be funded entirely by the local bank, but 100% guaranteed by the SBA. The anticipated funding time, and this is very much a moving target, is 1 to 2 weeks at the moment. There's certainly a big expectation out in the marketplace that this is going to be essentially file your application and get a check. It's not going to be quite that easy, but the banks are in the process of ramping up every bit of their infrastructure to be able to support what they know is going to be a crush of loans, and hope to get them out as quickly as possible, or get the funding out as quickly as possible. The important thing to understand is that these banks and the SBA have had a week to try to stand up this process to disperse $350 billion. It's understandable that they are kind of running a little bit behind, and certainly a little overwhelmed in this process. It was only last night at about 7 o'clock Eastern time, 4 o'clock Pacific time, that the SBA published their interim final rules notice that gave a little bit more definition to the banks on what their process is going to be. That doesn't give the banks a whole lot of time to line up their entire back-end process for processing these loans. So please be patient with the banks and with the government and with anybody that's helping you. It's very much a moving target. We're all going as fast as we can, but the banks are in many cases not going to be accepting applications today. If they are accepting them, it is highly unlikely they will be processing any of them until they've got all of those details worked out with the Treasury Department. So a little more about the features of the PPP, and this is a quite remarkable loan. It is partially to fully forgivable. We'll go through the details on that in a little bit. There are no personal guarantees required, no collateral is required. The application is about as simple as you can get. The documentation required is not particularly complex on the front end, but on the back end, it's going to be very important that you get all of your details right in order to maximize the forgiveness. And again, we'll talk about that in the forgiveness stage. Very significantly, the uses of the PPP are limited. in terms of forgiveness. You can use it for anything you want. It just becomes a loan at that point. But if you want forgiveness, it has to be used for very specific purposes, and we'll walk through the details on that as well. So let's contrast that PPP loan to the EIDL loan, which is the standard when you hear a disaster loan, disaster assistance after a hurricane or some other natural disaster. These are the loans and the facility that's out there through the SBA for small business owners to be able to get support while they reconstruct or rebuild their business. So the EIDL loans have a $2 million maximum. It is based on the demonstrated need. In other words, you have to say that you have had loss in order to be able to apply for this loan, and you have to be able to demonstrate what that loss has been. Unlike in the PPP, where you have to say, essentially, I need this. That's about the level of certification you have to go to on the PPP. The EIDL loans have a higher interest rate, a much longer term available for repayment. It does take a little bit longer to get those. There is no forgiveness portion to that, and you are required to do personal guarantees, personal financial statements, income tax returns, collateral has to be put up. There's quite a bit to that in a normal EIDL. It's a fairly complex process on the front end, not so difficult on the back end, and the uses of EIDL funds are much broader than they are for the PPP program. If you can go back to the table, please. Thank you. Okay, so I say in a normal EIDL loan. In the CARES Act, there is a provision for emergency EIDL loans that waives some of these items. We're not going to go into it in much detail here today, simply because it is still a very restrictive loan by comparison to the PPP, and it will still be a process. But some of the aspects of the normal EIDL loan process have been waived for purposes of the CARES Act. Let's talk about the EEIG. It's the Emergency Economic Injury Grant. That is a very small amount of money, $10,000 maximum. You basically have to ask for it in the context of submitting an EIDL application. You say, I need this advance right now, and within 3 days you get it. It's fully forgiven. Even if you don't get the EIDL loan, you don't have to pay the $10,000 back. You just pretty much have to ask for it. So those are the basic features that are out there of the different loan packages. As I said at the beginning, we're going to go through the details of the Paycheck Protection Program, the PPP loans, for the balance of this, because that's where the vast majority of interest and questions are. So with that, let's go into the details, and Matt Petrosky will take it from here.
Great. So I think the first thing that you want to ask if there is interest is, am I eligible? And there's a few different points that that are required. I think the first, as you see, is the business has to be operational on February 15th, 2020. Goal is not to have organizations create new entities that may qualify. So really, it has to be an organization that has been in operation. And it has to have no more than 500 employees. So this is targeted to small businesses, and that's really that's the goal. One thing to note, there is a general definition of what a small business is. The SBA is not new. This 500 employee limit is an expansion, and even some industries may actually be higher if you look on the SBA website, but generally speaking, it is the 500 limit. And we did get clarification in that interim final guidance that came out yesterday that the number does not include independent contractors. The third step is making sure that the current economic environment makes this loan request necessary. As John had mentioned, you must certify. It's under penalties of perjury. So as we like to say, this is not free money. This is for businesses that have been impacted by the economic environment. And finally, with that certification, I mentioned the good faith certification that there is a requirement, and also that to use the funds to retain workers, maintain payroll, and other debt obligations. So one of the things that you do need to do is use the funds for some of those required expenses.
All right, good morning. Let's go back one more slide. Just go back one slide, please. Hi, good morning, everybody. It's David Miller. Thanks a lot for that, Matt and John. So let's talk about the loan amount calculation. So this is really based on kind of a 12-month look back of your payroll costs. Now, we'll get into what that payroll cost definition is here in a moment, but a couple things to note. On the application, at least the application that's currently in the marketplace at the moment is requesting that you look at your 2019 payroll costs, so the entire 12 months of the payroll costs. Now the CARES Act, when you go into the CARES Act, actually says it's 12 months looking backwards from the loan origination date. So our advice is really to look at both, right? Particularly for bigger businesses that might have some turnover or some, a lot of change in of employees. It's really good to look at both to see where you can get the maximum calculation. So do that, and then you have to. On the next part of it is to be able to calculate the average monthly payroll cost. So basically, you're going to take those 12 months. That full year of costs, and you're going to divide it by 12, and that's going to give you your average monthly payroll cost, which is going to be the basis for this loan amount. And you can see very clearly that you're then going to multiply that. You'll see a lot of different things written out there. You take 250%, 10 weeks. So just basically, you're going to multiply it by 2.5, which is also on the application, and that's going to give you the result, the product, and then what you're going to do is compare that against $10 million, right? So the maximum loan amount is $10 million. So it's either the lesser of the $10 million, or if you're above $10 million, you're going to be requesting $10 million. So the next part of this is we're going to tell you a little bit more about what's in the payroll costs. So let's go to the next slide. I'm just going to say one thing as we're coming over to the slide, and I'm going to hand it over to one of my colleagues here in a second. Just as you're looking at those 12 months of payroll costs, just know that there's also a feature in there where you can annualize a particular individual's salary to kind of boost that loan amount. So for example, if you had turnover during the course of the year, that person, you can actually take the full value of that person. So they're only there 6 months. You can then annualize it for that particular person to kind of boost the overall base. So if you're kind of looking at a spreadsheet, you want to look at your 12 months. You want to look at your 12 months, and then you want to take another crack at it and take any of those people who may have turned over or a particular role that has transitioned during the year and annualize that during the part of the year to kind of boost that amount. All right, now we're on to the next slide. And
need to go back one slide.
We need to go back to the payroll cost. There you go. Jen, I think this is you.
Yeah, good morning, everybody. Hi, guys. This is Jen McCabe. This is the question of the week. What is included in payroll costs? Sorry about that. The first thing is that this is supposed to cover people's payroll costs. It's not just the base salary. So you're going to look at people's base salaries, which can include commissions and bonuses. It can include tips. If you've paid someone for a leave or a vacation, you include that too. So you look back at really what you paid someone. You can think about it as their W-2 box 1 wages. You need to exclude leaves, which we'll cover again below, if they were covered by the government. So of course, this is your cost. Remember, they're going to reimburse your cost, or they want you to be lent to based on what your payroll costs are, plus your employer paid costs. So in broad strokes, it's the salary up to a limit of $100,000. So if you paid someone $150,000, it's $100,000 in that wages and other commissions and bonuses. And then it's costs, which are employer costs. It's the employer portion of a 401k, for example, the employer portion of medical premiums, for example. And you are not to include federal tax expense. So you would not include your share of FICA. You can include your employer state and local tax. So if there are New Yorkers on the phone, there are New York city taxes that employers pay, for example, and most states have state unemployment that is billed to the employer. You can include that. Remember what not to include. That's the big question. No salary over $100,000. You also need, actually the whole thing is capped at $100,000 all in. So I'm going to use my example again on the 150. That person is capped at 100. If you're paying someone who makes $50,000, you can include the other things and get them to a higher number, but it cannot exceed $100,000. I hope I'm being really clear here. The next part is what you don't include. So you cap it at $100,000. You do not include 1099 contractors. The SBA, as Matt said, came out with guidance last night to clarify that. And that is primarily because they realize that if you're a true 1099 contractor, you are sole proprietor and eligible for your own PPP. So that was a gap in the legislation in that it wasn't very clear. There is a section that says federal taxes, which are your portion of FICA, cannot be included. You don't want to include the compensation of an employee who lives outside the United States. So generally speaking, those people wouldn't be on your payroll anyway, but you might have employees on your payroll getting a W-2 who are on a visa. If they're living in the United States, they're approved workers, they get a W-2, you can include them, even if they're not a United States citizen, even if they don't have a green card, but if they are on your payroll and working, you can include them in the calculation. You cannot include sick leave if you've been reimbursed by the government for it under the new Family First Act. So the FFCRA allows you to pay people and get 100% reimbursement from the government. So if you have paid for that sick leave, you need to get reimbursed by the government. You do not include it in your payroll cost basis. And same thing for the family leave. This family leave and the sick leave are both parts of the FFCRA. You get reimbursed separately for those things. Okay? All right, next slide.
Okay, let's move on to loan forgiveness. This is John Cogan, by the way. Whoop, almost had it. There we go. Loan forgiveness. So one of the most attractive elements of the PPP program is the fact that as much as 100% of the loan can be forgiven, but you do have to stay within guardrails in order to get your forgiveness. So the maximum forgivable amount is equal to the amount spent in an 8-week period after the loan origination date. So for example, if your loan originates on May 1st, you would have 8 weeks from May 1st, which would be near the end of June. And those guardrails are as follows. You need to be spending the loan dollars on that first sub-bullet: payroll costs, rent, utilities, and interest payment on mortgages. Note that any interest payments would need to be on leases and mortgages that were in place prior to the affected period, so prior to February 15th of 2020. The amount forgiven can be reduced in a few ways. It's actually in the act as reduction. So if you want to look for the base calculations here. But essentially, the act is intended to pay for people and salaries, and to the extent that you reduce the number of employees compared to the number that existed in one of two testing periods, so there's two baseline periods you can choose from, but if you reduce your employees during the period of time in which you're spending those dollars, then the forgiveness will be proportionately reduced. Furthermore, if there's a reduction in employees' wages greater than 25% during the most recent full quarter. So basically, if during the period in which you are spending the dollars, there's a greater than 25% reduction in salaries compared to what would currently be Q1 of 2020, then you will also have a proportional reduction in the amount forgiven. Those two are additive. Those two reductions are additive. Borrowers that rehire employees previously laid off but rehired by June 30th will not be penalized for reduced payroll. So you may have reduced payroll relative to the base periods at the beginning of your 8-week spending period, but as long as you climb back up and get fully rehired by June 30th, then you won't have that reduction penalty. The amount unforgiven, so the remaining amount, can be repaid over 2 years at a 1% interest rate with deferred payments of at least 6 months, and the Act says at least 6 and no more than 12 months, so somewhere in there. Presumably you would start making payments. Interestingly, there's no early prepayment of your loan amount penalty. Frequently there are penalties like that in loans, but not here. So if you have an amount left over and you don't think you are going to need it, then you can repay it early without penalties. Given the last few bullets here, you want to make sure you develop a strategy of how you might rehire folks and align that with any furloughs or layoffs to maximize the benefit of the forgiveness. That's the magic in this loan. Next slide.
Okay, so we've kind of run through a whole lot of the basic details of the Paycheck Protection Program. If you're not sure where to start, it's pretty easy. Let's go to the next slide. There's only a couple of steps to this. One is you need to run through the loan calculation. We went through some of the details on that. Obviously, there are some nuances to this, so you want to be very careful because those payroll costs are the basis upon which your loan amount is going to be determined, okay? Once you've run through that and you're comfortable, you've got all the right things in and all the right things out, you put it on a basic 2-page application, you certify a bunch of things, you make sure that you check the boxes that say you're not currently bankrupt and you're not a felon and all those things. But by and large, it's pretty simple. You just certify to a number of things, sign it, and submit it with your documentation to your bank. And each bank is going to have their own process for being able to do that. Some banks may require different documentation than others, so be prepared for that. But generally, they're going to want to have some kind of proof that you have calculated your employee count properly and that you're under 500, and that you have documentation to support the payroll costs that you're claiming. Once they've done that, you're pretty much ready to go, which is to get ready for the plan ahead. Okay, it's one thing to get the money. As we said, you have to spend it in certain ways if you want forgiveness. As I said earlier, you can spend it on whatever you want, just be prepared that you're going to have a loan that you're going to have to repay at that point. But the best thing to do is to put together a plan on how you're going to use the funds, when, how much, include a staffing plan in that, because an awful lot of you have already let people go. Do you rehire? When do you rehire? How do you rehire? Things like that. You want to make sure that you are planning the usage of these funds properly. And remember, it's an 8-week period. So there's a lot of thinking that needs to go into exactly how you're going to use these funds. And then make sure that your accounting system is tracking these costs properly. It's going to be very important that you can demonstrate that you have not intermingled the PPP loan funds with whatever funds you currently have, and that you're just sort of lumping it all together and spending it. At that point, it'll be very difficult to document what you truly spent these funds on. Okay, so as we've gone through this, hopefully you understand that there's a fair number of complexities involved in these loans. We have a number of ways that we can support you from Armanino. As a large CPA firm, we've got an awful lot of people with an awful lot of expertise in a variety of things associated with this program. So what we're happy to do, if you are interested, go to the next slide, please, would be to support you in any aspect of this process, from pre-application consulting, where we will just basically spend some time with you to answer your specific questions and make sure that you've calculated your loan amount properly, to assisting you through the application process, helping you do the loan amount calculation for you, help you gather the application materials, support that you're going to need, and walk with you through the loan approval process with your lender. And importantly, on the backside, once you've gotten the funding, that forgiveness and compliance management, as I was just alluding to and what John was talking about earlier, there's a lot of important things to get right if you want to have forgiveness on this loan. So we can certainly support you through that process and make sure that all the right things are happening there. Okay, so next slide, please. I believe that takes us to our Q&A, Megan. Oh, I jumped the gun there, sorry. One other thing that I do want to point out to people, if you go to our website, armaninollp.com, that's ARMANINO LLP.com, which you see down there in the bottom of the slide. Then from our homepage, you can get to our COVID-19 Resource Center, which has something like 60 or 70 different blog articles and checklists and things like that that get into specific details around each of the different 5 aspects of the coronavirus response issues that are affecting businesses that you see here on the page. So I encourage you to visit that resource center. There is a wealth of great information out there. And with that, Megan, I'll turn it back over to you.
Thank you, John. And thank you to all of our panelists. We do have a lot of questions coming in. I think I mentioned earlier, I don't think that we'll actually be able to get to quite all of them, but we also got a large number in advance. So I've put them up here so that you guys can see which ones we will be answering at least right away. And then as we have time, we will see if we can get to more of them as well. So Jen, I think that this first one is actually for you. Does the $100,000 payroll cost per person limit mean I exclude that person's wages entirely, or do I only exclude payroll expenses that are over the $100,000 per person?
It's $100,000 payroll cost per person. So you get up against that $100,000 limit, you burden it, and then you stop. You do not have to throw out highly compensated people entirely. You can include them up to $100,000.
Perfect, thank you. David, this next one was for you. Can I include 1099 contractors in my payroll cost as a basis for my loan?
So I think we were pretty clear about that. The answer is now today, no. The one thing I'll add is the 1099 contractors and sole proprietors can also apply for relief themselves. So by excluding them in the calculation, we're basically making sure the government's making sure there's no double dipping. There are other individual programs and opportunities for relief. So if you are an independent contractor or a sole proprietor, evaluate your best option. And then just one thing I'll add, I know we've spoken to a number of real estate entities who may be thinking you can include the contractors. It's best you share this direction with your independent contractors, and for your loan calculations, only include the payroll costs.
Thank you. Matt, I use a PEO. Can I apply and use my payroll expenses?
So the answer to this is yes, if you do have a co-employer agreement. And I think it's important. A lot of companies use those external payroll providers. They handle the payroll, they file the W-2s. If your company's name is on the W-2 as the employer, then you can. and the W-2 documents will support your application and use of the funds.
Awesome. John, I believe that this one was directed towards you yesterday. Can I have both SBA loans, the EIDL, and also the PPP?
The answer is yes. There's been a lot of misinformation about this out there, but the answer is very clearly yes if you get into the details of the act. The difference between the two is the use of the funds. So you can have an EIDL loan in addition to a PPP loan, but you cannot use them for the same purpose. So again, you're going to have very good segregation of your funds and your uses of those funds in your accounting system. But if, for example, you wanted to use EIDL funds to pay a supplier, you absolutely can do that. If you want to use PPP funds to pay a supplier, you can't if you're using the EIDL funds to do it. You have to use the PPP funds for a different purpose. And then that gets into the forgiveness. If you do choose to use PPP funds to pay a supplier, which you can do, you just won't get that portion of the loan forgiven.
Good clarification there. Jen, do I include workers' comp in the payroll expense when I calculate my base pay?
The answer to that is no. Workers' comp is an insurance policy for the employer that in this case, we're not including in fringe, primarily because there's no specific guidance that would say you could include it, and because it's often treated like insurance, just like any other company insurance policy. So our guidance is don't include it.
Thank you, Jen. Matt, do I need to file my 2019 taxes before I apply?
And the answer to this is no. And there's still some question as to exactly what documentations each bank will require. The guidance has just said that you must submit such documentation as is necessary to establish about eligibility, such as payroll processor records, payroll tax filings, or Form 1099, or income and expense from sole proprietorship. So it does not require a 2019 tax return.
Thank you, Matt. David, I actually have two for you. I think John might have spoken about this a little bit as well, but what banks are doing this program?
Sure. So this is a really fascinating question this morning. So generally, what I can say is the banks that are authorized to be SBA lenders are the ones who will be doing the lending. And the big banks, typically Chase, Wells Fargo, Bank of America, Citibank, for the largest banks in America, are all banks that will be doing the lending. However, a couple things. One is if you check their sites today, they're not ready. So they will. My understanding from each one of these banks is that they will be setting up an electronic filing, electronic application process. They're also certainly Chase and Wells have verified that you need to be a business banking customer with them. There's some information I have on the cutoff for being a business banking customer. Some of them I've seen there's a business banking cutoff as of 2/15, but that I haven't confirmed. So my biggest advice is to go start with your own banker first, and check with them and see if they're going to be supporting the program. And keep your eyes on these bigger banks: Chase, Wells Fargo, Bank of America, and Citibank, because they're going to be rolling out their website soon. As John mentioned earlier, the information was just released late last night, so the banks are scrambling to get that in place as we speak.
Yeah, let me jump in there for a second, because most of the questions on my email this morning are about this very topic. They want to know what bank to go to. So everybody who's listening, stay calm. As David has said, the banks are working on it. The big banks who are used to working with the SBA and have an SBA department that's already up and running, such as Wells Fargo, Bank of America, Chase, Union Bank, they're maybe ahead of the game because they understand how to work with the SBA. But they're big banks and a lot of people don't want to bank with them. And so they want to go to their local bank. And the SBA has said this is going to be okay. You're going to be able to work with your warm and comfy local bank. The local banks have to set up the technology to talk to the SBA, and that really can't be done, which John said in the very beginning, in 4 days. It's almost an impossible ask. But they're sending out calming emails this morning saying that they do still expect to be able to administer PPP loans. They just need to get the time to get it right. So I encourage you all, as David said, to start with your bank and your banker where you have a relationship where someone can help you and take care of you. And we're here talking to those very banks all day, every day.
Thanks, Jen. Thanks, David. That actually covered the second question as well, which was where do I submit my application? So Jen, actually continuing on with you, we've gotten a number of questions this morning about how do I count my 500 employees?
Sorry. We have gotten a lot of questions about this. The application itself asks for the number of positions at a company. So that will include full-time and part-time positions. Remember, the goal of the program is to protect paychecks. It's called the Paycheck Protection Program. So if you're a company with 10 full-time employees and 10 part-time employees in normal times, whatever that is now, what they want is to see that you're trying to maintain those 10 and 10 jobs. So you would say, I have 20 positions at my company. That's how you answer the front page of the application. The CARES Act does talk about both full-time and part-time jobs. Now there's another term that's being used, and it probably is going to be strategic for you all to understand this term. In the loan forgiveness language, they talk about full-time equivalents, or we also shorten that to be FTEs, full-time equivalents. In an FTE context, 2 20-hour-a-week employees are 1 full-time equivalent. So my advice to everybody is that when you do your application and you're calculating your average payroll costs for a month, you also figure out what your average number of positions is. And remember, at the end of the 8-week period, you're going to have to show them that you're maintaining as much as you can your payroll. So if you end up at the end of 8 weeks with 9 full-time and 9 part-time people, they may prorate the amount of the loan they forgive. And that's okay, because if the other 10% stays in your bank and you have to term it out and call it a loan, that's okay. But they're going to look at the number of positions that you have on your original application, and they're going to compare it to the number of positions you have on June 30th. That's a very critical date. So you're going to count both FTEs right now so that you can talk to them about it when you're justifying your use of funds, in case that comes up as a helpful justification. And then you're also going to give them the number of positions. I do think that there is a lot to plan ahead for when John was talking about planning when you bring people back to your workforce. You might bring back 3 people part-time instead of 2 full-timers. This is why they're going to start asking about FTEs and not just positions, because there's a lot of anticipation that people will change the makeup of their workforce in order to pivot and meet the new economic circumstances. So be strategic, count it both ways, answer the application exactly as they're asking you to, but think ahead. You might not want to say that you have 50 positions if the average that you've had is closer to 40 when you look at it across 12 months, because they're basing the application on the dollars of your average payroll. They're basing the amount they give you. And then they're going to see what you've done with the number of jobs. So be very cognizant of both counts.
Thanks, Jen. That was great clarification. We've gotten that question tons and tons of times this morning, and I'm sure that we'll continue getting it. But appreciate that explanation. John, one for you. And Jen touched on this a bit as well, but we can add some clarification here. Can I use the PPP loan proceeds to pay off debt?
Sure you can. Just not going to be able to get that portion of the loan forgiven. It's going to be a loan to pay off a loan, in essence. So yes is the short answer, but just be very clear about the forgivable portion of anything related to debt is the interest portion of the debt. Anything you pay off in terms of principal is not forgivable.
Right, and let me jump in there for a second to really pound that home, because Matt and I were talking about this earlier. You can use the proceeds for things, but remember on the affidavit that you sign at the beginning of the application, it says, and I'm going to use it for payroll and operating expenses. I'm going to use it to operate my business. They're not going to be excited about you using these proceeds to pay off debt or to refinance something. It's not just that you can't go out and buy a motorcycle. You have to use it to keep your business on the ground and people employed. So if you use that, they're not going to forgive the proceeds, and they might actually not be stoked at the end of the 8-week period when they look at you.
It is entirely possible that they lower your forgiveness even further. So the basic guidance here would be don't do that, but it's not something that is absolutely forbidden.
Jen, I think this next one was for you as well. Can I take advantage of the federal payroll tax deferral plan if I'm applying for the PPP?
This is another big question. So there's another program in the CARES Act that allows employers to stop paying their portion of Social Security as of last Monday. So your payroll always has a 6.2% expense for the employer, and you can elect not to have that paid. And you can defer that payroll tax for 2 years. You pay half of it December 31st, 2021, and half of it in 2022. Those of you with a lot of people on the payroll, be a significant amount of cash into your pocket now. In the there's language that do that, have had given SBA lending program. You who are applying, you don't know if you're going to get the money. You don't know if you're going to get forgiven. If you get the debt money, I mean, the PPP money, fantastic. You don't know how much of it will be forgiven. So our advice is that until you get this money forgiven, which very likely not going to be until third or fourth quarter this year, defer taxes. We're interpreting the language in the CARES Act very technically. Matt, who is on the phone, on the, whatever you call this thing, the webinar with us, has looked at it with me, and he has more technical training than I do. And we've really come up with the stand here that we're going to do both until we have debt forgiveness. My advice is use the other program to get.
Jen, we might have lost your audio there, so we might need you to repeat that last component of it.
I'm so sorry.
Getting on the router. What Jen was saying, Jen, maybe I'll just finish this one and then you can add in. But essentially, the language in the deferral statute says you cannot have had loan forgiveness, past tense. So kind of thinking that the position of you can claim deferral up until the loan forgiveness. It seems clear that pay any
issues, so I apologize. Hopefully you guys can hear me as well still. And of course, as we mentioned, we will get to as many of the questions as we possibly can. So apologies for anyone experiencing those audio issues this morning. John, this one is for you. Am I eligible if my business hasn't been interrupted?
Yes, you are, depending on your definition of interrupted, but let's be clear about what the affidavit requires in the course of application. You need to be able to, at the current certainty makes this necessary to support operations of the applicant. You just need to be, I need this money. It's pretty much the bar. So straight interruption that I need this as far as it goes. Back to on around being that I was a little bit, yeah, you probably firmer in not supposed to. There is also, as Jen pointed out in her last comments, various other certifications, including how you're going to use the money. There is a statement in the application that says, I understand that if the funds are used for unauthorized purposes, the federal government may pursue criminal fraud charges. They're going to be so overwhelmed. I think the likelihood of them doing that is probably not all that high, but because of that threat, pretty much would recommend you don't do it.
Thank you, John. Let's see if we can get one in here for Matt. Again, apologies for the audio issues. If we continue to experience it, we will see if we can answer all of them offline instead. Matt, this one is actually a two-part question. We got in this morning. Apply for the PP companies owned by a foreign.
Hopefully everyone can, again, apologies. I know all web-based platforms are getting a significant amount of additional usage now that we're all working from home. But I'd say this is one of the more complicated issues. It goes back to the affiliation rules in the SBA regulations. I think to know that the PP is new. The SBA, so you do need to look at the organizational structure. You should through it with counsel. There are a number of different ways that affiliation can occur. There's affiliation based on stock ownership, some affiliations based on stock options, convertible securities and agreements to merge, and then finally based on common management. So I would just caution you to review. And then I think there was another question of, if I am owned by a foreign entity or person, can I apply? Now, there is a specific definition of a business concern. This is also going back to the SBA regulations. And the answer is, a business concern can include a foreign company or individual if they have a physical location in the United States and contribute to the economy. And they can do that through payroll. So it is specifically in the regulations. But again, for those foreign entities, I would say just make sure that you look to the affiliation rules as well to see whether that puts you over the 500 and out of eligibility.
Thank you. So it sounds like I'm hearing that our is getting a little bit better. We will, of course, be sharing slides in the recording for anyone who was unable to hear anything. So we've got a few more questions. Matt, this one is also for you as well. Can a hospital that is not a 501c3 apply for the PPP?
The answer is yes if it's a veterans organization. If it's exempt 501c19, the answer is yes. I think the PPP is pretty clear that only certain specified nonprofit organizations can apply. I think most people are familiar with 501c3 charitable organizations, but it's pretty clear that other organizations can. And is a small is also a for then all the other definitions.
Thanks, Matt. It seems like we are actually back to having some poor audio issues. So what we're going to do is close it out. We know that there are tons and tons of questions in the chat window from when you all registered. And then, of course, we did have one more FAQ here. But we will definitely be able to work through all of those questions, through them back. Apologies, we seem to go to webinar this, but this was at least a good work on getting back. Mentioned earlier, we do have a COVID-19 resource center up on our website. You can get to it from our homepage. It has a ton of different insights and resources that you can use around the SBA loans, around all of these topics, and a lot of other things that are also related to COVID-19. Definitely encourage you all to check that out. And feel free to reach out to our team. We are here to help you. We understand that this is a crazy time of disruption, so we're definitely here to help. And thank you all for joining us this morning.